And it's interesting if you look through the history of recessions, and you know, breaking down, I was looking at some work done, breaking down which recessions were caused by Fed tightening, as opposed to sort of exogenous shocks or financial crises. There's different factors that cause recessions, but this is a man-made recession. This is driven by the Fed tightening, okay? And when you see sort of a recession driven by Fed tightening, what happens is they do work with a lag, but from a market perspective, the recessions tend to be much more mild, okay? Because as I say, the Fed, as they realize they've tightened too far, starts to back off. And when they start to back off, as I say, the economy will start to recover, but markets recover before the economy does. And so the timeline I'm looking into the fourth quarter, I think we're going to see evidence that the economy is slowing down. Inflation, we need to see evidence. I mean, Jay Powell used the word compelling evidence that inflation is coming down. Okay, and so it's a higher bar of lower inflation for the Fed to change than where we were 2 weeks ago, which is why I think it's a bumpier, tougher summer. But once that sort of evidence starts coming in, and sometime in the fall, and the Fed starts, you know, the Fed is going to have to pivot again to a more a less hawkish stance than they currently outlined. And it's that when that happens, or when the market expects that to happen, I expect that you're going to put the bottom in for the market. So markets will move in anticipation of it, and that is the history of when the Fed is the cause of the recession and the cause of the bear market, the Fed is also the cause of the bottoming and the recovery.